So I'd firstly like to welcome council members to this workshop, which is about recurrent budget and rating strategy. I'd also like to welcome anyone who might be watching on YouTube this evening. And I also would like to acknowledge the land we gather on tonight is the traditional lands for the Kaurna people, and that we respect their spiritual relationship with their country. We also acknowledge the Kaurna people as the custodians of the Greater Adelaide region, and that their cultural and heritage beliefs are still as important to the living Kaurna people today. So this workshop has been convened in accordance with Section 90A of the Local Government Act for the purposes of discussing the current budget and rating strategy. This session is solely for the purpose of information sharing and not for the purpose of debating issues, building consensus positions or otherwise discharging council's deliberative and decision-making functions. There's no agenda, no minutes will be taken, and I'm turning my phone off to limit disruption. If you need to take a phone call, please take it outside. Please don't take it while you're sitting here. If you can, turn your phone onto silent, if you can, please. That's enough about phones. We won't be going into confidence, I don't believe. No? So we won't be going into confidence. So I think now I'll hand over. We've got this in front of us that I've just seen. I haven't looked at it yet. Don't know what's in there. There's a lot in there, actually. A lot. Okay. I'll hand over to Sharon now, our Manager of Finance, and you can take us through, Sharon. Thank you. Do you want to turn your mic on, Sharon? Thank you.
Thanks, ma'am. So tonight we will just be providing an overview of the operating budget. So just for a bit of a recap, so predominantly at the couple of weeks ago, we presented the new initiatives and the capital budget to you. And so tonight we'll actually also add the recurrent budget, which relates to the continuing services of the council. So that's our existing services. And what I've actually handed out tonight, so there is a copy of the presentation, so you've got a hard copy of the presentation in front of you, and also following on from a memo from this session held on the 21st, we realised that we actually forgot to answer a couple of questions that were asked, so I've also included a memo providing those responses to the questions regarding the brand strategy and the replacement of the vehicle fleet. So that's just for your information as well. So what we'll also do is that we'll put an electronic copy of both the memo and the presentation on the hub, so you can actually refer to it later electronically. So just a bit of the first couple of slides are just pretty much similar to the format that I provided in the information session from back in December. So this just basically this graph or diagram shows where our funding sources are and how we're actually spending on it. So the presumption here is with respect to the new initiatives, it's as presented from the other week. With regard to the capital expenditure component, staff, we have actually gone back and looked at some of the items and we have made some modifications or adjustments to the upgrade component of the capital works, capital program. And so these figures actually reflect that. I'll put the bad news first. So at the moment, as per the current draft budget, it is reporting an operating deficit of around $2.6 million. We acknowledge the fact that that's not an acceptable draft budget to actually go out, and that we do know that there's things that actually need to do that to actually reduce that deficit, because it's actually not a sustainable deficit. However, at this point in time, it's still based on new initiatives of around $1.2 million and the capital program of around about $10 million as well. So we do, and I'll just go through it in a bit more detail as we go through. Again, so in relation to the operating budget, from I suppose a mix of where our revenue comes from and where our operating expenditure goes, there hasn't actually been necessarily much change in the mix. The biggest thing is in relation to our recurrent income is that the fact that we're actually going to start getting a drop off of our grants and contributions, you know, from that perspective as well. So one aspect at this point in time, which we haven't accounted for because the current or the last budget indicated that funding from our supplementary road income, which just for the benefit of the new members in the room, what happens is that the federal government provides us some financial assistance grants, and which incorporates just for general revenue plus some road maintenance spend. And that is part of the arrangement in the sense that the council is responsible for the maintenance of the roads within its local area. However, the allocation of that funding is based on a population component, whereas from South Australia's perspective, our population as a share of the total Australian population is a lot less than the roads that South Australia is actually responsible for. So in the past, this federal government has actually provided some additional funding to South Australian councils to actually make that to balance out that inequity. However, in the last budget papers, they have basically said that 22-23 was the last year that was actually going to get funded, and there was no guarantee that that funding would continue to come to South Australia for future years. So at this point in time, and for the town of Gawler, that's around about $163,000. At this point in time, we haven't actually included that in the operating or the grants income. However, what may happen is that as part of the federal government's budget, which they will deliver in May, I think it's around May, that actually may be reinstated. So we will actually take that up. But realistically, there's no guarantee that. So it's probably not prudent for us to actually include that as a funding source, because the government has to and fro with regard to actually providing that funding, depending on where the budget is. Personal opinion, this is my personal opinion, given what's actually happened with regard to the floods and the level of infrastructure spend to that needs to actually happen, I think that they will reinstate that, and potentially for another 2 years.
Just quickly, Shane, would that just be on the eastern states? Because that's where a lot of the flooding was. So you're going to be holistic around the whole country?
Supplementary funding is just for South Australia. Yeah, it's traditionally been a yearly thing, and Sharon's absolutely right. That every year, when I was on the board of ALGA, every year they'd say that we wouldn't get it again, and every year we got it. So I don't know, but I think given the impact of flooding up in the Riverland and elsewhere, I think that they probably will. Usually goes through the Grants Commission and they divvy it up. Is that right? Yeah, that's right. Yeah, yeah. I'm not. It's hard to say what they're going to do, because you know, they usually put it through the Grants Commission and they divvy it up. They use a sort of an algorithm to equitably, I can't say that word. I can't even say that word. I'm getting myself tongue-tied. Equitable, that's what it is. Equitable funding across South Australia. But yeah, it's always used as a bit of a stick we're not going to give it to you. We're not, because South Australia actually gets less per capita head than every other state in the country. So it's well known, and that's why it was argued to get that extra funding. So yeah, I don't know if we'll get it or not, but I think it's prudent not to have it in the budget. I think that's wise in case we don't get it. Yeah.
So yeah, so it is actually designated to South Australia, and effectively it gets if they're going to provide the supplementary road funding, they will provide it to all councils, and it will be distributed based on the same distribution factor that the rest of the grants money is actually going for that roads component, and that's based on the length of road that you're responsible for. So as a proportion of all councils. Again, I think that with the cost pressures and with the flooding, and yes, there's been a lot of flooding on the eastern states, but there's also been a lot of flooding in WA and up north as well. So I think it will just be generally, that's my personal opinion. I could be wrong. And again, ultimately it depends on what the federal government wants to do with respect to its budget as well, because they operate on a cash component. So, if they want to have a bad deficit for the 22-23 because they want to have potentially a better budget, they'll bring forward and give us the cash and all that sort of stuff as well. Am I cynical or not? But anyway. Bit of realist there, and all that sort of stuff. So again, but I think it's probably at this point in time to make decisions on the basis that we may get it is probably not really a good position to be in. Just from a capital perspective, so at the moment, the capital expenditure, including loans that would be loan repayments, we do have a couple of fixed term loans that are tailing off. That we are committed to loan repayment, principal repayments is around about $11 million for the next financial year. That's predominantly, I suppose, a lot of the funding source comes through rate revenue, theoretically from our depreciation charge. Then we do have some capital grants, and then there's some borrowings as well that will be required to provide the shortfall. You might recall back in January, I know it wasn't that far ago, but it probably seems like a lifetime ago, you considered a report on the budget timetable. And within that report, there was an indication of some of the initial parameters that would be communicated to staff as to sit there and say, these are the sort of expectations with regard to our budget for this financial year. So the rate revenue increase, which was based on what was in the long-term financial plan. So that had a general increase, which pretty much covers cost indexation, was 4.5%. And then we have growth from new assessments. So this is actually just increase in the number of properties that we actually have. It doesn't take into account, I suppose, that natural growth from capital values. So the draft budget that presented that represents the $2.6 million deficit is actually based on a 6% rate revenue increase. Personally, given the economic conditions at this point in time, I personally believe that general cost increase or general increase in rate revenue is probably too low. What we've actually got is, well, considering that we're actually having increased, that increase doesn't actually cover the base increase in our expenses as well. So effectively, that's one of the other factors that is actually contributing to that operating deficit. Revenue.
So with the rate increase, which people will look at, and the, average member like myself in the community will go, how much is my rates going to go up by? What percentage point does that equate to?
Unfortunately, I'm not in a position to actually communicate that yet because we haven't actually got our valuation information. There's a whole heap of factors. Obviously, the rate revenue increase, obviously the rate revenue increase is how much extra revenue that we actually need to raise.
Mhm.
And then the distribution of that across, and what the average rate is for the average residential ultimately depends on the valuation and how much our rate in the dollar is actually impacted by one, new assessments. You know, we're forecasting around about 1.5%. So that's probably around about an extra 150, 160 properties coming on board. So I don't know if Andrew has any idea about how many new assessments, I suppose new dwellings that have been completed.
Yeah.
We won't know that until we get the valuation information and then what the change in the capital value is. I have done, as we go through, I have done some very basic modelling, which I will sit there and say that there's a lot of caveats on it because I'm just making a whole heap of assumptions that may or may not come true.
Yes. Yeah.
And all that sort of stuff as well. So it
We won't
depends on-
hold you to that.
No,
Sharon.
don't hold me to
Promise.
promises. Yeah. But yeah, so realistically, normally what will happen is to sit there and say, in general, you know, obviously there's around about a third of the community will pay less than what they paid last year. A third will pay around the average and a third will pay more. Because we're actually accounting for growth, what you actually find is that, and we have general valuation increases. And I think even though we are getting interest rate increases, and so I suppose the property market has been slowing, the valuations are actually struck based on 1st of January. So I don't think the full impact of those, the slowing of the property market would come into the true impact of our properties as for this financial year. So I wouldn't be surprised if we're still getting high valuation growths in the plus 10, 10 area, and all that sort of stuff as well. So
I might take a question from David Hughes and then go to Paul Kosh.
I didn't really have a question. There was these estimates are actually on page 15, that with the average rate in the dollar was
But
around it.
that's that basic modelling that you'll
where
explain,
it
Sharon.
stands. Which isn't set yet.
No.
And I think, Joe, as a general comment, we've got to really look for savings through the whole budgeting process. Joe, I'm thinking, Joe, those positions and everything else, we just have to be really careful.
Okay. Thank you. Now, Councillor Kosh, I think you had your hand up as well.
Yep, I think the ratepayers tend to look at the CPI and go, why is my rates going up more than the CPI? But can you just explain what, because that's a certain basket of goods, but when we consume goods in a council, we're not buying loaves of breads or televisions or trips overseas. We're buying bitumen and all that sort of stuff. Do you want to talk about that?
So yeah, you're right. So normally what will happen is that obviously the CPI or inflation figure is pretty much one of the things that everyone can relate to, but that does take into account like there's a few elements that we as a council will consume, obviously fuel, the cost of finance and all those elements. But again, we don't buy groceries, we don't go out and buy houses and all that sort of stuff as well, like the general consumer. There is the local government price index, which basically takes into account, I suppose, all the predominant cost inputs that a typical council would actually use, and does determine what the cost to local government has actually happened. At the moment, the only problem with that is that it's not as the information is not collected as frequent as the CPI. So there is a long lag between that. And from memory, I think from the December quarter, which was the last published quarter, I think that the CPI, the local government price index was around about 7.3%. You know, so it is sort of, it's still tracking pretty much in line with with CPI. So, you know, but there is sometimes where the local government price index will be far in excess of CPI, but there's also opportunity, like sometimes when some of our input prices are lower. However, I think, you know, when you think about the cost of oil and the cost of petrol, and that's one of the key inputs into the cost of bitumen and all that sort of stuff, those elements do have a big impact on us as well.
I might get you to keep moving.
Yep.
Yep. Is that okay, councillor Kosh?
Yep.
Yep. Okay. Getting excited. That's good to hear.
And so this is just basically pretty much a summary of the elements that actually come up into making up that $2.5 million deficit at this point in time. So recurrent operating is basically our general existing services that we provide. You know, so that is the town services, the provision of the library, the provision of the swimming centre, basically you guys in the room, the cost to actually have the council itself, the cost of administration. So at the moment, and I think that this is one of the things that probably need to have a look at. And yes, I agree, Councillor Hughes, that we do have to actually look at making savings, but I think we can't discount the fact of what the impact of the last couple of years with COVID, and particularly that period where in like 2021, 22, where we did have low rate increases because, you know, because of COVID and all that sort of stuff, that actually does have a massive impact and a compounding impact on the operations and the sustainability of the councils. Because effectively the cost for us to deliver our services didn't stop as well, you know. So, you know, we were still subject to those price increases, but we still had to deliver that, but we weren't necessarily getting the level of income that was required to actually counteract those increases that everyone in the whole community, you know, in business and everyone is actually experiencing. So we do have a compounding impact that we actually need to make sure that the decisions that we make today aren't actually making things worse for the future as well. And I know it's really hard. I know it's a really hard decision to sort of sit there and say, oh, actually, we're going to have, we have to have a higher rate increase. But I think it's also, I suppose, for the community's benefit as well, sometimes that is actually going to be the responsible thing to do as well, because it's the question of, you know, if you reduce expenses, you know, we are a growth council. So every year, you know, we are actually increasing the service level that we actually have to provide, because we've actually got new reserves coming on, you know. So this year we had in 23-24 budget, we've got reserves coming on that we have to maintain because they've been gifted to us through the new development. So we just have to, it is a delicate balance between what making savings, but also making sure that what we're actually collecting from the community is fair and reasonable for the services that we are actually, and the costs that we're actually having to incur. So, and even going back to the comment that from Councillor Hughes about the fact that we have to actually make savings, realistically, you know, despite the increases in expenses, like, you know, the cost of inputs and all that sort of stuff, our materials and contract spend, and the fact that we've had new reserves come on that we have to now maintain through the Aspire estate, through Oleander, through and all the, you know, just basically, I think from information that I got from Wendy was that, you know, just through some of those estates, we now have to maintain an extra 400 street trees, which means that, you know, there's more maintaining, like pruning and all that sort of stuff that we actually have to cater for. So and those increases have actually been built into that materials and contracts and other expenses line. You know, so staff are being conscious of the fact of this pressure not to actually increase costs, you know, just willy-nilly, you know, because that increase, if you go back to if we go back to the previous page, if I get this right. Do I move back, David? Lost connection. Oh no, got it, Henry. You know, so materials and contracts, you know, despite a inflation rate of around 4.5–5%, or 6%, you know, our material and contract expenditure in total budget had, excluding the operating initiatives, this is straight on our recurrent, has actually only increased by 3.5%. So, you know, so we've had some increased pressures. You know, we know that electricity prices have gone up. You know, fortunately, we've had the LED project, so you know, so that's been able to counterbalance that, and the guys at the depot, because pretty much most of this expenditure comes from the depot, they have actually been looking at the ways that they can actually do some of this stuff without actually adding, I suppose, adding those prices on as well. So you know, and again, I think we always talk about going back to the normal. I suppose I don't know what the normal is, and I don't know when the normal is going to return, if the normal ever returns as well. So, you know, and realistically, when I suppose those inflationary impacts will go back to the Reserve Bank's requirements of between around the 2 to 3%. You know, the forecast at the moment for 30th of June is 6.7. So it doesn't seem as though it's going to come down anytime, like within the next 12 to 18 months. So, you know, I'll probably be saying the same things again next year, in the sense that we're still dealing with probably a high inflation factor as well. So yes, we need to look at expenses, but I don't think expenses is the answer, is the complete answer that we need to take into account. So just probably spoken about it, a lot of this sort of stuff. I think that there is one thing that in that rate revenue, there is 2 discretionary rebates that the council actually do provide to businesses in the Starplex and the Jockey Club, which probably I think is probably subject to an eligibility review. Those discretionary rebates were granted back in 2013, and I think probably that the circumstances in which those discretionary rebates were granted is probably well and truly gone, and all that sort of stuff. So I would probably be putting a report to council for reconsideration of those, because personally I don't believe that they actually meet the eligibility criteria of the Local Government Act, and in which those grants were provided.
I think we're giving them free rates, aren't we? Free rent of the land.
I do, effectively, if it's on land, if it's on rateable land, we would charge them rates. I don't know if it's council land and we charge them a lease fee. I suppose that's probably a bit of a different issue. I don't know. Yeah. Yeah, but I know we don't give them any discretionary rebates. I don't know. But yeah. So I'll probably, you know, so I will flag that, you know, and realistically, like I think that discretionary rebate last year was around $90,000. So, you know, it is a big rebate. And realistically, I think that that's probably something that needs to be reconsidered. And obviously within that rate revenue figure, we still allow that discretionary rebate for the tiered, for the commercial. So that is still part of the, I suppose, the overall rating strategy. I talked about the grant income and all that sort of stuff as well. So I suppose the only thing as well is that we do collect a lot of developed contributions, obviously through Gawler East and all that sort of stuff. They're there for, I suppose, future infrastructure works. So they shouldn't be recognised as general. We can use them until we can use the funds, I suppose, that pool of funds, but a recognition of as that's not operating income. So we need to actually make sure that we take that out of, I suppose, out of the equation when we're determining what we need to cover for our operating expenses. And realistically, only committed grant funding is actually accounted for. So, you know, there might be potential opportunities for future grants out there because they're normally on a competitive basis and that we have to apply for them and all that sort of stuff. So those sorts of things are, I would sit there and say, realistically, windfall gains that we actually take advantage of when we actually go through the budget year as well, you know, and realistically, any grant opportunities that come up during the year from a capital perspective, we should actually be making sure that we're actually only applying for grants where we can actually offset existing projects within our current year portfolio, rather than actually creating new projects, because effectively those grant funds normally come with us putting our hand in the pocket as well. So where we can actually offset our existing works is probably where we should actually be going for grant income, because while people say it's free money, it's not free money. There's always a commitment that we have to actually make to it as well. So and realistically, operating grant income is very minor. Most of it's just for the library operations, a bit of hack for our home, what is it? Commonwealth Home Assist program, and then our general financial assistance grant as well. So, but again, as we go through the year, if there's any opportunities to offset any recurrent spend, potentially like from Green Adelaide or not, or, you know, those greening organisations, potentially to offset, you know, planting of trees and all that sort of stuff, we'll continue to do that and look at those opportunities as well as we go through. Statutory charges, 2.5%. Most of these fees and charges, the amount we collect is very minor, you know, other than parking fines. But what we actually, the rate is determined by the state government, and so we won't know what any increases associated with that until they announce that in the state budget or leading up to that state budget. So there has been a bit of an uplift in revenue driven by planning. And that's from the assessment and building consent for fees. However, that is pretty much fairly fickle as well, because that actually depends on how much development is actually happening as well in the area. And then we've got a bit of an uplift in our user fees. So most of our increase in revenue is actually being driven by rate increase, and that's where most of our areas that like any substantial increase is actually going to come from. Employee expenses represents around about 37% of total operating expenditure, which is pretty standard across the industry, across the sector. We have had a big impact on the EA increase has actually contributed towards around about $780,000 of the increase in our employee expenses. And then we actually do have, I suppose, the compound impact of that of the increase in the superannuation guarantee, which moves from 10.5% to 11% this financial year and progressively increases until it reaches to 12%. What we've actually also done within the draft budget is that we've actually recognised the fact that while we would like to have everyone employed from day 1 through to 30th of June, that's not the case, and that we will have vacancies during the year, and it takes time to actually fill those vacancies, especially in today's employment market, although it is actually probably there's probably more activity and more application, people applying for those roles. So we have actually allowed for around about $250,000 to account in for the fact that we will make savings because we will have vacancies where we won't necessarily have to actually backfill during that recruitment process. So obviously any customer service or customer facing roles, we've actually allowed for the fact that we actually do need someone in that position. So we'll probably backfill that position through short-term employment. But any other positions that don't need to be filled, we do recognise that. Last year, you might recall that there was an EA, the EA increase was based on CPI, which was above the 2.75%. So to counteract that for the 2023 year, what happened was that there was a budget savings for very similar from vacant positions to actually reduce the impact for that one-off increase. However, that's actually a one-off impact. So that's a double factor that's actually incorporating that increase in employee expenses. Contract and material expenses, again, 36% of the operating budget. Again, we are assuming the electricity tariffs will continue to high. However, we have actually incorporated the savings from the LED project. So it was actually quite fortuitous that we've actually delivered that project this financial year, because otherwise we would have had a massive cost impact because the volatility in the electricity market isn't actually improving. So we will continue to expect that we will actually be getting fairly high tariffs associated with that. And again, as I said, as the new developments like Aspire and Oleander Waters and Springwood finish and get developed and finish their stages, there is a whole heap of assets that are actually now getting handed back to, I suppose, not handed back, handed over to council, who now is responsible for the maintenance of those. So the 12 months, I suppose, period or defect period is over, and we're responsible for that. So we actually are maintaining more areas, and we have to actually take into account that of those increases as well. Appreciation, big component of our budget. Obviously it's a non-cash component. We are, again, and I think this is where the cost of the inputs from a local government perspective is really starting to hit us, because the unit prices to replace, because effectively at December, the cost increase of the capital inputs was around about 12 to 13%. That is a massive increase. That is well above, I suppose, the CPI. And those are the flow-on impacts that we're actually starting to feel, in the sense that this is actually impacting on, I suppose, our asset values, because we have to revalue them based on our the replacement cost based on the current unit rates. So we have got which we think will have around about $550,000 impact this year, which will actually flow on. And again, the impact of the receipt of our gifted infrastructure as a result of these housing developments as well is flowing through to that depreciation, because while we're not paying for the capital cost to actually, I suppose, bring those assets into existence, we now have to actually fund the replacement of that infrastructure over the life of those assets. So, and I'll use Mawson Lakes as an example. So that was, so yes, the developer developed that property, those roads and all that sort of stuff. However, they built those roads for car traffic, whereas they had years of heavy trucks going to-ing and froing. And so by the time that those assets were handed back to Salisbury Council had to go pretty much within a couple of years do a reseal because the conditions of the road. So so those sorts of things that we need to actually take into account, and which will impact that depreciation. aspect of the thing, aspect of our budget. And obviously we've got the initiatives budget, which at the moment represents 4%, is at nearly $1.2 million. There is, plus there is those positions, those additional positions that we talked about, which is added in there. And again, I think as a growth council, we need to be cognizant of the fact that we are going to have to increase our workforce because we are got more greater responsibilities and services that we have to maintain at a particular service standard as well. And unfortunately, when you actually get new developments on, the service standard gets lifted, and the service standard gets lifted, and the expectations get lifted across the whole community, not just those communities within that development as well, which we need to actually also manage going forward.
The new position. Can you explain that line to me, please? I'm trying to get my head around it.
So what actually has happened? So a couple of weeks ago, when we went through the new initiatives, there were 4 positions that were proposed: the social planner, the business, the economic development officer, a health and environmental and immunisation officer, and a civil trainee. So with respect to the immunisation officer, so what actually happens with that position is that that's to provide additional immunisation services because the grade 7 getting pulled into high school. And so we are actually expecting greater and giving immunisations. However, we do get funded for the level of immunisations. So that income, so we actually do receive some income so that we're not actually necessarily paying for the full position. The same with the trainees. So as a trainee, there's schemes out there that provide a rebate for organisations taking on trainees, and we get partially funded. So pretty much with the immunisation officer, which isn't necessarily a new position, but increasing that from a part-time role to a full-time role, I think the shortfall is probably around about $10,000 a year. And then the same with regard to the trainees. So that's where I'm talking about. So the net cost to council for those 4 additional roles is around about estimated to be around about 287,000. That's per year, isn't it? Per year, yeah.
So
Yeah.
it's around 55,000. Bloody thing. And but it's with contributions of 68,000. So my understanding that those 4 people give a contribution back in maintaining and gaining $68,000. That's the way I understand what you're saying. When is a review done of the actual sections? Is there such a thing? I remember about 15 years ago, there was a review done for the actual works depot, and people came in, they did the review and all. Is there ever reviews done on all sections of the council? And is it important? Because I've been saying for a long time, I think we've got some wonderful staff, but I do believe that some of the staff could step up. And I'm completely objective to employing any more people. When you look at the ratio which we're paying out in wages compared to our income, and the wages are half of the income that we are bringing in.
So Brian, we have over the years targeted different parts of the business for reviews, predominantly external reviews and some internal reviews also. The current main review that's occurring relates to the depot and the service operations, and that's been a little bit longer in the processing because, you know, staff turnover, but we have engaged an external party. We've been doing a lot of back of house analysis of, you know, service levels and data and so forth. We are having a tour of the council area, so the new council get a sense of what the external staff are doing. And so that's going to be an important part of this new council's considerations over the next year or so relative to what is a 3, 6 and 9 year focus in terms of the insourcing and outsourcing of those services. In terms of these additional positions, we as the executive have presented them as being for consideration on the table. We acknowledge that a $2.5 million deficit isn't palatable, and I'm sure there'll be a conversation about which of those 4 positions need to be cut.
Okay, I'm going to go to the Deputy Mayor now.
Thank you, Karen. So I'm listening, and I completely agree that, you know, we're getting reserves handed over, new estates come online, there's more service levels that we need to agree to, the pressures that come with all that, and we see all that. The 4 new positions, the closest one that we are to combat any of that is a civil trainee in that space. Am I correct in saying that?
That's my assumption.
Yep, correct. However, I think that there's also in relation to some of the extra pressures from being as part of the Growth Council as well, which is some of those, especially from a social planner perspective, will actually address some of those other infrastructure issues that need to be addressed and that need to be considered as part of that financial sustainability things as well, you know, and I will go, you know, like, I know that we're doing the budget for 22-23, but effectively the decision, like, you know, so the things that you decide to cut today potentially may have like implications for the future as well. And those are the sorts of things as well, you know. So yes, while I'm saying that at the moment we're increasing, we have got reserves handed over, and yes, we've got a civil trainee, and that's one of the things that are addressing. But I think there's other things in with regard to the social planner and the economic development officer that I suppose I've heard discussions around the chamber in the short time I've been here, but effectively to sit there and say, you know, as a community and as a council, we want things to happen in other areas of the businesses of the organisation as well. And realistically, if you don't have the resources in-house or the expertise in-house to do that, how do you do that? And I'll just go back to Brian's comment as to sit there and say, yes, employee expenses are a big component of our budget, but effectively, fundamentally, we're a service industry, we're a service provider, and in all service provision organisations, labour and employees is your biggest assets and is one of your biggest expenses, you know. So it is to sit there and say, okay, yes, it's a big thing, but effectively, if you don't have the people on the ground to actually deliver the services or to manage those contractors that you're actually outsourcing that to do, you cannot deliver those services. So I hear you, but I think that's something that as an organisation, as a service organisation, it's something that we can't get away with. And the percentage of total, our employee expenses as a percentage of total total income is not disproportionate to any other servicing industry or service organisation, if you actually did that comparison. And realistically, from a local government perspective, it's between 30 to 40%, and that ultimately just depends on how much work you insource versus outsource.
I'm just going to pick up on the senior social and community planner. There's 14 dot points. Some of the dot points have 6 dot points underneath them. There's that much in this role that you'd need 2 people to actually deliver on what's in this document. It's actually quite unsustainable. So I would actually suggest that whatever the job description will be, needs to be a lot less than what's in here, because this is not sustainable. When you've got 14 dot points and the top one has 6, and then the majority of them have 3 or 4 dot points. And so it goes on. So I thought I'd just raise that, because I think it's unsustainable. I do write job descriptions. I've done many over the past few years, and I also know, you know, the capacity of people. If this is a full-time position, how is this person going to actually deliver on what's in here? So I would encourage the staff to review that and maybe cut a few things out, because I don't think it's sustainable. We've been given a memo, which is in front of you, and I'm looking at page 4. Okay, 3rd of March, yeah. Have you not got it, Cody? Why hasn't Cody got it?
So the document that the mayor's referring to is the document that was sent out last Thursday, which provided the responses to the questions that came from the 21st. So the additional document that was provided tonight in hard copy was a couple of extra questions.
Who sent it out? Who sent it out?
So you got a hard copy, because we sent it out with the council agenda on Thursday, but effectively, because not all members get the council agenda electronic hard copy, they basically
Who
got.
sent it out so that we can find the email, so that we can actually go back and look at it?
It's on the hub. So it's on the hub as it would have come out with
Under the elected member notice?
on the notice board.
On the
yeah.
notice board, okay. All right.
So an email, I would have sent out an email last Thursday saying that it's on the hub.
Okay, thank you. So I'm looking at page 4 through to page 6, 4 and 6, and there's quite a number of dot points. And I just think that, look, I actually don't have a problem with the social and community planner. I think that there's some value in that, but I don't think they're going to be able to deliver on all these dot points. So I think that's just maybe some feedback to maybe take on board. Yes, Councillor Davies.
So noting that, you know, we have the initiative budget, which represents 4% of our budget. Another area, just noting that we have the ability to change some things is in recurring expenses, which I presume is all under this contract material and other expenses category of 36%. But for example, reducing the average level of water spent on, so like saying this,
Would you like a breakdown of further breakdown? Is that possible to get a breakdown, Sharon?
Yeah, you can provide it, but I suppose the question is to sit there and say, I'm going to give you a number, and it is, we can provide you breaking down back basically to that granular level. But again, and I suppose it is that thing is to sit there and say, okay, well, what are you making it against to sit there and say, okay, well, how much do we spend on watering reserves? How much we spend on watering reserves ultimately depends on the service level that we're providing. And I suppose it's probably that question about is to sit there and say, okay, well, that's probably more the question that you actually need to ask, not how much we're spending, what's an acceptable service level? Do you want every single park
I think it's a reasonable question to ask for a breakdown.
I can provide the breakdown, but again, it's that same scenario of saying, okay, I can tell you how much. Do you want to know how much we spend on water? How much we spend irrigating and all that sort of stuff. I have the information, but realistically, without personally from a service level perspective, what is it? You can.
Well, I
suppose there's a consequence of reducing the amount of water.
We have had reports in the past around service levels, and how we, what we do at a particular service level. So those reports exist. I think it is not unreasonable to ask for a breakdown. I'll go to Councillor Hennessy. Have you got another question, Councillor Davies?
Just clarifying, yeah, I don't just, the raw numbers on their own are fairly meaningless, as you said, and what I was trying to get at was more the service level reviews of, understanding, here's our parks, here's our reserves, here's, their use, like these are things that get reviewed, but it would just be great to have some of that information in front of us.
Thank you. Now I'll go to Councillor Hennessy.
Thank you. Yeah, I'd like to see the community events spelled out. I think, again, understanding that they're a current budget, but I think we need to be mindful and perhaps put into the public arena what we are spending.
I'm sorry, I didn't hear that first bit.
The community events.
Oh, yes,
So
sorry.
that, that area,
yes.
I'd like to see, again, just broken out so that we can explain and review what's going into those, the breadth of what we're supporting.
And again, I think that's not particularly difficult to find. I think, David, that's part of your portfolio. Do you want to respond to that question?
There is a report going to CCS next week on all of our activation strategy events, which is the community events that council supports in the outdoor environment. We can pull the community events we do in the indoor environment separately. They are reported through such things as civic centre updates and rec services, but we can pull that separately. Yep.
Does that help, Councillor Hennessy?
Yes, that will do, but I might, for example, there's been discussion in the community, great discussion about how council helps support Christmas functions. Now, I'm very much aware that we do support a wide range of those. Some of those would be indoor as well as outdoor. So I'm just trying to find, I think that would be worthwhile information to have.
So both indoor and outdoor.
I
so that
think
covers...
it might help, yes.
Yeah, okay, thank you. Any other questions at this stage? I might go back to Sharon. Thank you, Sharon.
Just to answer your question, so we spend about $600,000 on water consumption. So is that the right number? Is that not the right number? I know that we have been doing things from smart irrigation and all that sort of stuff to actually address that going forward. But I take on board with regard to I suppose breaking it down into services and probably what that key services is one of the things that I suppose going forward from a and even in communicating that to the community, I'm probably a big advocate rather than actually just reporting those numbers, because they don't make sense to anyone, and breaking it down to I suppose key services, very similar to the way I broke down the operating initiatives on that, and presenting the budget to the community through the annual business plan in that format as well. But I suppose at this point in time, being new to the organisation and also being early into the budget process and all that sort of stuff, some of that information is not necessarily readily available. But so I do agree with you, but realistically, but I probably don't necessarily say giving you the raw numbers is actually going to be of much value to you, because there's no context around it, and that's where I do have this information, but you're going to say, what does it mean? And I think that that's probably more important to doing that. And again, yes, it can be done. Can't sit there and say that it can be done in a really quick, easy process at this point in time. I still need to get my head around that.
Thank you. Yes, Councillor Davies.
Yeah, I was thinking about, for example, when we get saddled with new developments and then the level of water and that sort of thing that they have promised their residents is quite high, and it's not necessarily what we have for the rest of the town. That's the kind of context that, not just raw numbers in a document, but, like, here's what's happening here, kind of that kind of situation.
Yes, Councillor Kosh.
a couple of years ago, council passed a motion saying that all reserves will be kept at the same level as was provided by the developer. And that was passed by, one or two councils ago. It's probably worthwhile actually looking at that again, because it takes away the ability of staff to modify the service level at those reserves. It may be worth looking at that motion, because it hamstrings the staff and council, because it's at a level which is, I think, beyond beyond the reasonable, financially responsible status of a council, really, because you're actually talking about what a developer does to sell blocks of land.
Thank you. Now, we might go back to Sharon and we'll keep moving. Thank you, Sharon.
So just to reiterate, I suppose we're not immune to the current economic conditions that are impacting everyone. And I think it is that thing about, and it's impacting all aspects of the organisation. Obviously, it's predominantly, you know, the depot because they provide most of the services. You know, there is instability in the electricity market. There is, you know, the high fuel prices through the you know, hopefully the war in Ukraine will stop and that will have a bit more stability in that. There is still supply chain pressures that we're actually experiencing that, you know, as we say, with regard to the fleet, you know, we have, you know, it's good to sit there and say that we're going to replace, you know, with different cars. It's just that we can't get them anyway. So, you know, and the cost of some of those vehicles are just too high at this point in time. Staff availability, as I said, like while the employment market is actually getting a bit more flexible and a bit more fluid, we're still experiencing, we do have the issue about the fact that we're not a metro council. So, you know, attracting staff to come here is a challenge that we need to, and it's across the whole organisation. It's at the depot, getting depot staff. It's also from an administration perspective. Again, and even the businesses are also feeling those pressures with regard to staff availability. So that's actually and those supply chain issues and the fuel prices issues, which is actually having a general increase on our contract prices. And obviously there's salary and wages increases because obviously we are in a period where there's high inflation. We haven't had a lot of wage growth, so there is that upward pressure, and like combining all these together, you know, we can cope individually for one of these things, but effectively we're getting it from all fronts, and the compound impact of that is actually quite high. So at the moment, the draft budget, excluding depreciation, is providing a cash surplus of $5.3 million. And at a minimum, that should actually be funding our renewal program, which at the moment, including our capitalised salaries, which basically takes into account, I suppose, our engineering staff that are managing those projects, is $5.2 million. And then we've got around about $830,000 of loan repayments that we have to make on our fixed term borrowings. So that actually doesn't leave much scope but to do anything much more. You know, we've got $70,000 there. You know, so realistically, from a financial sustainability perspective, you know, that's where we actually need to increase in some of that capacity in generating some of that cash surpluses, because if we're not generating high enough cash surpluses, your goal of actually paying down debt so you can do major projects like the pool and like Carbethan and like the Southern Sporting Precinct and all those things that you want to do, in addition to all the things that we have to do in relation to, we know that we've actually got traffic pressures from you know, listening to the people here today, to sit there and say, you know, having that development, it's going to cause increased traffic pressures. So we're going to have to build new roads, or we're going to have to actually address that. So that actually doesn't provide us the capacity, because effectively we don't have that ability to pay down our debt. And we don't have this endless pit of money, unfortunately. So there is some things that we actually need to address. We're not going to solve it overnight, but I think that this is actually one thing that we've probably sort of sit there and say, okay, well, you know, from this budget, this is where we actually need to start addressing some of those big issues to actually make sure that we can actually position ourselves going forward. Obviously, as I said, you know, rates is a key component. It's our main source of income. You know, we can't get away from that in the sense that, you know, realistically, around 80% of our income comes from our community and comes from our ratepayers. This is for the benefit of the new people in the room. So I do apologise for people that have been on council for a long time and that have seen this process. However, I just thought I'd do just pretty much a quick one-on-one 101, rates 101. And that sort of demonstrates the fact that potentially what your rate revenue increase doesn't actually translate to a straight translation into, you know, you can have a 4% rate revenue increase, but that doesn't necessarily mean translates that to for the average residential ratepayer or the average ratepayer. So obviously we have our rate revenue and we divide that by a capital value to come into a rate in the dollar. That rate in the dollar is used to distribute our rate collections, the rate revenue that we actually wanted to collect from our property owners across the city. We use capital value because obviously capital value is being seen as an indicator of capacity to pay. And I know that there are some people in the community that are probably property wealthy but income poor. That doesn't necessarily equate. But generally, you know, your ability to service a bigger house means that, and a bigger property and a higher value house means that generally you have greater wealth. You know, whether that's right or wrong, whether that applies to everyone in the community, but on general, that's the case. So I've taken 23 just to demonstrate that. So effectively in 21-22, we had an average capital value across, this is just residential, of around about $322,000. We had a rate in the dollar at that point in time, which is a high rate in the dollar, a 5, you know, it is a high rate in the dollar. And that actually equated to, for a person in the community that owns a house that's valued at $322,000 from a capital value perspective, would actually pay $1,700 in rates in 21-22. 22-23, what we actually had as well is that we had increased capital values. You know, that was actually where that's coming out of the post-COVID period. So there were high capital value growth increases. And also in relation to Gawler for 22-23, you had exceptionally high growth in new development. You had around about 3.6%, which is massive. So you had a lot of new assessments coming on board. So what that actually did, those two factors together actually meant, and then you had around about, I think, a 6.4% rate revenue increase.
Deputy Mayor, I'll just Deputy Mayor's going to ask a question.
Thank you. So just to clarify, we're talking about the average house. What if you owned a pub?
Commercial rates are tiered. Yeah.
So yeah, so I think it's just simple to deal with the general rate, but yeah, effectively, so these are the rate in dollars for commercial properties. So under current rating policy, there is a differential rate that applies to commercial and industrial properties, which is around about, I think from memory, 150, around 150% on top of that general rate the commercial properties will actually pay.
But they're tiered depending on how much their property is worth.
No, they're not. The rate isn't tiered. And then what you actually do then is that you provide effectively a discretionary rebate back to the commercial properties to actually counteract the fact that you want more expected commercial properties that are higher in value, the Coles, the Big W, the Woolworths,
That's right.
those big property owners, those big businesses will actually pay that full extra on top. Whereas the smaller businesses, the Java Hut, the Poetic Justice and all that sort of stuff, we will rebate a portion up to, I think the maximum rebate at this point in time is 40% of that back to them as well. So that's, you know, if you go back to the slide, I said that there was around about $1.3 million discretionary rates. That is actually what we actually rebate back to the commercial and industrial, the commercial sector and industrial sector
then-
based on property value.
Yeah, and that's mainly the smaller operators, the smaller value properties.
Yes. Yeah.
Yeah.
And the idea is to bring them closer back down to the residential rate.
I'm just going to go to Deputy Mayor again.
So, sorry, just quickly, because I think it's important to understand when we are voting to increase rates, what that actually means to all our ratepayers. I get the average, and it's really, really handy to have this because this is the majority of our population. But when we're voting to increase rates, we also need to understand what that does to our other ratepayers in the town that aren't fitting in this particular average as well, which I'm sure will come. It was just the feedback there.
Thanks, Sharon.
As I said, this is just an illustrated example of generally, because irrespective of what happens with the commercial sector, the principle is exactly the same. So we had in 22-23, we had increased property values and we had increased growth within the council area. So that actually increased the capital value. And so what we actually do then is to sit there and say, we still have that fixed bucket of money of what we actually need to collect, and to actually make sure to counterbalance that, that increase in capital value, what we actually do is we adjust the rate in the dollar. So there's two components of your rate increase. So as I said, capital value for residential across the board increased 16%. And so the rate payable increase, which was $37, was actually made up of a rate increase due to capital value. So if we didn't change the rate in the dollar, this property owner would have paid an extra $275 in rates for that year. But then what we've actually done, what we actually do is that we adjust the rate in the dollar down, and effectively the impact of that rate in the dollar moving from 5.529 to 4.635 was that we actually effectively gave back $238 to have a net increase of $37, which for this property was actually only a 2.3% rate increase, but we actually increased our rate revenue by 6.4%. So you can still have a high rate revenue increase, but it doesn't necessarily translate that will actually be a linear relationship between to your ratepayer as well. So, yeah. I don't know if you're across this, but literally, like, so last financial year there was some local government reform. This is probably the response to the response of I think it was the Liberal government at that point in time, to rate capping. They couldn't get rate capping in, so what they actually did was that effectively through the annual business plan, councils had to be more transparent about what was actually happening with their rate revenue, and they had to actually be consistent from each council. So effectively in the legislation, there's minimum things that every council has to disclose in their annual business plan, and they have to disclose it in a particular way. Because I will sit there and tell you that you could sit there and say, okay, well, what messaging do you want to tell? message do you want to go out there? And you could actually come up with a number that basically supports that. So, you know, and across the industry, and I even know when I speak to equivalent people across the council, when I talk about a rate increase, I'm talking about rate revenue. Whereas I know that other people talk about rate revenue plus growth, or what's the average rate, and all that sort of stuff. So there was always this people speaking at cross purposes and no one really understanding what you're talking about and thinking that you're talking about the same thing, but you weren't actually talking about the same thing. You know, people sit there and say Adelaide City Council was a classic to sit there and say, we haven't increased the rate, because they're saying, okay, well, I'm not changing my rate in the dollar. So I'm actually taking the full impact of the valuation increases and all that sort of stuff. So, you know, they can sit there and say, oh, we haven't had any rate increase, but effectively their revenue might have increased by, you know, $100,000 because I've had massive property value increases. So, you know, is that fair? Is that fair to the community as well? So there are a couple of things here. I won't go through all of them, but there's just be cognizant of to sit there and say, this is how we actually need to communicate within the annual business plan, how we actually talk about what the average is, because, and the average that we talk in the annual business plan is different to what the average rates payable for the average residential payable person is. And again, you know, so capital value will still be used. So even though we've changed the definition, or the definition of what average rate means has been defined, you know, we still have to actually, we will still be using capital value to distribute it. The rates payable of what you as an individual property owner will still be used, calculated by applying the rate in the dollar to the capital value, and all those sorts of things as well. So the way we calculate rates is still the same. The way we communicate it to ensure that we're consistent from council to council, so you can make, I suppose, those comparable things, is what this legislation has actually done. So obviously, with regard to, yes, we can decrease expenses, and I think it's right. We do need to address some of the expenses things, but obviously we also need to increase. The other option is increase our rate revenue. So this table just basically sorts of sits there and says, gives some options, gives what happened for the last 2 financial years and what the operating surpluses were as a result of those rate increases. And effectively, I've given multiple options. The light blue is what the draft budget is actually based on. The dark blue is essentially CPI plus growth. And we have actually gone out to other councils to find out what they're doing. And a lot of the other councils are erring towards the CPI plus growth figure of around 8%. So, and all that sort of stuff. Yep. So that's, you know, realistically,
I'm just going to make a comment there. I don't think that would be very palatable.
I'm just saying that this is what it is, because effectively, you know, all the councils are starting to feel the pressure of the cost increases, and effectively, you know, and from that perspective. So yes, yeah.
I think we said 250,000 was 1%
Yeah.
rate.
That's right.
Is that right? So if we want to get it down, we have to take off 250,000 per 1%. So that's what we need to basically look at. So we need to really try to find that sweet spot and reduce our expenditures by that. Yeah. That's the way.
So the councils that you're speaking to, that are you finding out about the 8% they're leaning towards that, where do they sit in what they pay rates wise in comparison to us? Like, you know, are they comparative councils?
They're a combination of metro and non-metro. So like I know that Adelaide Plains has responded. So effectively they're saying CPI, you know, so they're going at that higher end. And they're actually going based on March CPI. So, you know, so realistically, that's probably a higher a high level then rather than the forecast CPI as at June. So it is a combination. We've asked Barossa, we've asked our neighbouring councils, but we've also asked metro councils as well, and even the metro councils, which I find surprising, in the sense that some of those metro councils are still going for that such a high, because obviously they have greater capacity because they have high asset values and all that sort of stuff, and they're still they will be experience probably the growth greater than what we would out here as well, but they're still going that way as well, which does surprise me. But again, we are asking all surrounding councils of effectively combination of metro and non-metro as well. So we're not sort of sitting there saying, I'm not saying, Onkaparinga is going for 8.8%. So, we are asking, and that's the general consensus that's actually coming back from the people that have responded so far.
Thank you, Sharon. I'll go to Councillor Davies.
Yeah, I think it's worth remembering as well, to some extent, we can lower the new initiatives budget. But a lot of that stuff is stuff that we'll have to do at some point. So if, for example, we decide not to do the Williston Cemetery stuff this year, then it's going to happen next year, so there is, to some extent, we can say there's initiatives that are not necessarily time sensitive or that kind of thing, but just pointing out that as a growth council as well. And sometimes there are things that are more expensive the longer you leave it as well. So we'll have to look through it all carefully with new initiatives when we're reviewing it.
Yeah, something to think about.
And there's also the compounding impact as well. It's to sit there and say, you can have the compounding impact of having a higher rate this year actually is greater than having a lower rate this year and then having to have a higher rate in 3 years' time. And I know that there's the political environment as well, as to sit there and say, but again, yes, there's still a lot of things that the community wants.
So a question around the deficit. So staff are reviewing the draft budget currently, is that correct?
So we are continually reviewing it. We're continually trying to identify areas where obviously both in Recurrent and obviously also the initiatives. So, I think that there will probably be a set of initiatives that we as administration probably think that there are non-negotiables, because, realistically where we are at this point in time, we need to actually address some of those things. Like, realistically, we think in light of some of the comments that it came through from the code amendment discussion tonight, we would sit there and say that the transport study that we've got in the initiatives budget is probably a non-negotiable, along with the growth framework as well, because we think that those things are critical for the town for positioning itself for the future and dealing with some of the growth factors and the pressures that we're actually facing. So I think that there will probably be a presentation of what we believe is non-negotiables. And then obviously, and then that's up to the council as to whether they agree with, I suppose, our definition of what we believe.
But there'll be some initiatives that you'll say can be not funded this year?
Yep.
Okay.
So yeah, so there is some things to sit there and say, it's probably not essential. It's not time critical, but again, there will be some. I think our position is these are the non-negotiables from our perspective of what we know going forward and potential impacts.
I think that will be really helpful to the elected member group.
Yep.
But certainly looking at, what can be set aside for this year as against the non-negotiables. But I think that would be quite useful to the elected member group, just to understand where the administration is coming from and work collaboratively to, I guess, improve that deficit. So I think we could definitely improve it. Okay. Keep going, Sharon.
So just in relation to, and this is my very basic modelling, and I don't know how you've ever seen modelling before, but this is what I'm used to. So I've made some really I've just made assumptions here, and it is quite a linear relationship. So I've assumed that effectively, capital values will increase by half of what they actually did for last year. So, from that perspective, and obviously I've just taken the fact that we're going to get our 1.5% increase in annual assessments as well. And done the modelling for each of the rate revenue increases. And I think that this is one of the things that I probably wanted to demonstrate as well. One of the things that, because this is a linear relationship, this is just some really basic maths. There is a bit more complex math behind rate modelling, which my little head brain can't do on a simple spreadsheet. So that's why, so what I would actually probably expect, all things being equal, lots of caveats on this, is that the difference between the rate revenue increase and the average rate change in the percentage for the average rate payable would actually probably be a bit greater. So, you know, depending on all the other factors as well, because I've still made the assumption that effectively we're going to get 75% of our rate revenue from our residential sector, you know, but if we actually have a increase in capital value growth from our commercial sector, which is greater than our residential sector, we might actually find that we're actually getting a shift of that rate burden across to the commercial sector, which basically means that for the residential ratepayer, their rate impact will actually be a lot less. So the average rate per assessment is basically demonstration as per what's required under the new legislation. Again, it's simple math. But realistically, we're probably talking around about a $80 increase for based on 6%, and obviously $100, assuming my capital value and both figures are actually correct. I won't go through each of the detail and all that sort of stuff, but I suppose one of the things is to sit there and say, as your capital value increases, your rate in the dollar is actually decreasing, you know, so because in proportion to your rate increase. So as long as your rate revenue increase, excluding growth, is less than your increase in your capital value, you'll actually see that falling rate in the dollar. So again, it's just straight maths. It just gives you an indication of what sort of the impact, going back to the question that the Mayor asked earlier, as to what does that mean to the community, and that's pretty much initial thoughts with lots of caveats, but don't hold me to it.
That's a theoretical modelling.
Theoretical modelling.
We have
based without valuations and just simple math.
Okay.
And again, this will work.
We've also got the commercial.
And then we've got the commercial again as well, commercial. This is actually before the rebates. So this is just basically as a, you know, so you would sit there and say, okay, well, this is what a Woolworths would pay. Obviously, because we actually give the rebates back,
It'd be good to have that tiered system included.
Yep, I can do. I'll do that when you're considering the budget, and all that sort of stuff as well.
I think some members have never seen it, so it'd be good to share that.
Yep. So yeah, so pretty much that's where we're at. Again, I think there is some strong consideration needs to actually be given to increasing the rate revenue increase. And then this last table just basically sits there and says with those rate revenue changes and then with some reduction, and I've only looked at the initiatives, you know, what sort of operating surpluses or operating deficit or will we have realistically, by just looking at a reduction in the value of the initiatives that we actually deliver. Again, I don't think this financial year you will be in a position to actually to go out with a budget in surplus. The long-term financial plan that was adopted, that's on the website, basically didn't predict that you would actually we'd be in surplus this year. The issue that we actually have is to sit there and say, without a higher rate revenue increase, because of the increase in the cost pressures that we're facing, without a higher rate revenue increase this year, it will actually take you longer to actually get back into that surplus position as well, which potentially does have that impact on the ability to deliver some of those iconic projects that you want to, you know, that you want to actually deliver, because that just takes into account, you know, doing, you know, a new upgrade program of around about $5 or $6 million a year.
Is that the last slide? Okay, any questions? Councillor Davies?
Yeah, so, you know, presumably the long-term plan has a plan in which it does go into surplus. What are the factors, I guess, of this budget or of future budgets that are non-annual regular occurrences that are sort of throwing things out in one direction or another, I guess would be my question. You know, like we've had some, you know, oh, we have to pay off this Gawler East Link Road thing, you know, for 3 years we have to pay, you know, $500,000 or that kind of, are there any factors like that, I guess, that relate to this year in particular?
No, not really. There's probably increasing expenses that are probably, you know, I'll be honest with you, as to sit there and say, I haven't necessarily got my head around all the idiosyncrasies of, I suppose, the developer contributions and the contributions. And obviously, we've included in this year's budget some contributions that we actually have to make for infrastructure and what's under development deeds and development agreements and what we've actually got going forward and all that sort of stuff. But I would sit there and say my comment about the long-term financial plan at this point in time is that it's pretty much, you know, a vanilla position, and it's still going to take a period of time. If you don't sort of sit there and think at this point, for this budget, this is the time to consider. I suppose you've got, you know, you've got the opportunity, because we actually are in a period of high inflation. You know, we are in a period of increasing cost pressures that everyone knows about, you know, so, you know, and I know it's to sit there and say, okay, well, you know, well, we should just jump on the bandwagon because everyone else is, but effectively we're experiencing it, you know, so we shouldn't be, you know, on the other side, we shouldn't be a martyr either, because effectively being a martyr is actually going to cost us more in the long run than it is sitting there saying, okay, well, we just have to face reality at this point in time of we can't absorb the level of increase that is actually being impacted, plus having the level of growth and the level of infrastructure and all that sort of stuff that we need to do, that the community wants us to do. You know, the community needs to actually, you know, and it is all, again, you know, it's to sit there and say, okay, from that messaging and making sure, and I get that it's a really delicate message that we have to actually communicate, but we actually have to demonstrate in the information that we go out to community consultation with, and in presentation of that, you are actually getting value for money. You know, we're not just squandering that money and you
Some-
are actually doing that.
Some
stuff.
people won't be able to pay their rates. So I think we need to be cognizant of people's capacity to pay. And I think we need to be sensible with our rate rises. I hear exactly what you're saying. But there also needs to be some advice from the administration on what can be taken out, safely can be taken out, that is palatable. Yeah, it is a tricky one, and you're right that the message needs to be quite delicate. But I don't think, I think that, you know, going out with a, where is it? 8% rate rise. Or where is it? 6.
So effectively it would probably be so it's
Yeah.
6.5%, because
Yeah,
1.5% of
6.5%.
that is actually growth.
It's quite a big jump for people, and you know, I think that we need to think carefully before we make that decision.
You know, and don't get me wrong, I sit there and say, you know, I'm not advocating that, you know, realistically, you know, for a, you know, that a $2.5 million deficit is appropriate, or any deficit is appropriate, or just increasing rates for the sake of it. But effectively, I think it is that, you know, it wouldn't also, from my perspective, it would be irresponsible of me not saying about the fact of what that impact, understanding that impact of what you're doing today will potentially have on the future as well.
I think there's a fine balance of
There is.
of what you take out and what rate rise you put in. Because if we just put up a rate rise and don't take anything out, I think that probably wouldn't be well received.
And I'm not, and I would never, and I don't advocate, and I'm not advocating that now, either. You know, as I said, you know, we as administration, we acknowledge the fact that some of those operating initiatives have to actually come out, and that we have to be probably smarter in some of the ways that we actually do things as well, because obviously, you know, it's, as I said before, I don't think these cost pressures are going to go away in the next 12 months. You know, I think we'll probably be having the same discussion, maybe not to the same degree, but we'll probably be having the same discussion in 12 months' time. You know, so that's where I'm sort of sitting there thinking, okay, well, you know, some of the stuff that we actually do, because if we don't do that balance between a combination of reducing expenses and also looking at what is a reasonable rate increase, given the current economic conditions, there will be a point in time where you're going to be forced to do it.
I think,
and that's where you don't necessarily want to be forced to do it.
And I think we need to show fiscal responsibility. In, you know, we can't deliver this, but we might be able to deliver it next year, etc. It's a tricky one, and it will be a balancing act going forward. Well, thank you, Sharon, for that presentation.
So I suppose just going from next steps, from this perspective, I suppose my initial thoughts were probably presenting the draft budget for consideration at the next council meeting, the March council meeting. However, I think at this point in time, I think I should be presenting it at a special council meeting, where the focus is just on the budget. So there will be some.
We won't have time within council
and I don't think
properly discuss it.
And I don't think we'll give it justice. So we'll probably be organising a special council meeting just to do this.
Will we have another workshop around proposals that would be taken out?
My thought was we could just present them and you can have that discussion, and maybe if we have it as a special council meeting, we can suspend meeting procedures and have a bit more of a discussion. So I suppose we can have another workshop, but effectively it's at some point in time when, well, I suppose from an administration perspective, we need to actually have a decision of the council so we can continue to work forward towards that as well.
I think given that we have a new council and this is our first budget, I think that having another workshop to really nut out before we go to the special council meeting so that people don't get surprises when they open up their packet and, you know, they come, oh, what am I going to do about that? So I think having another workshop might be useful to really understand that, okay, this is what your thoughts are. This is what our thoughts are from an elected member point of view and come to a hopefully consensus view, maybe not through a workshop, but, you know, throw some ideas around and then bring that to the special council meeting. I just think that opening up your packet and not knowing what's in it is a little bit of a shock sometimes when you're looking at some of the initiatives, etc. So I think it's important. That's just my view, Deputy Mayor.
Yeah, I agree, purely because we need to promote that open conversation and given how meetings are and the timing of those. Also, the process around the draft budget, we need to understand what we as elected members are allowed to do in moving motions to say, yes, we want this above the line, below the line, etc., etc. The process around that needs to be explained, I think, and would be really good to be able to hash that out in a workshop environment.
Yeah, I think so. Because there is a little process that we go that we've put in place in the last couple of years with particularly elected member bids, particularly around elected member bids. We can look at the administration recommendations, but elected member bids, if they haven't got a motion on the books, it's really important to actually get a motion on the books so that council either agrees or disagrees. And we've done that via motions on notice to that special council meeting, but we can talk about that at our workshop. I really think we need another workshop. I don't think we're quite ready to go and endorse the budget out for public consultation just yet. I don't think that will work.
Just from my perspective, that workshop wouldn't be endorsing it.
No, we won't be endorsing anything.
That special council meeting that I'm talking about wouldn't be endorsing it for public consultation. Effectively, I would be sitting there saying, okay, well, you're endorsing the budget as it stands, so then it's in a position to actually go back to the audit committee, because I still strongly believe that the council should consider the budget and endorse the budget as what they are comfortable in presenting before the audit committee actually sits there and sees the budget, and
we
for
normally
them
do
to
that
provide.
the other way around. We normally do that the other way around. We normally have the audit committee provide advice to council on what they think, you know, we should be considering.
And I understand that, but I suppose from my perspective, I don't think it's fair on the council for the audit committee to make comment on a budget that they haven't said whether they support or not support. You know, that's my personal.
That's what they're there to do. That's what they're there to do. They're there to advise council, on financial governance.
I agree that they're there to provide advice, but I suppose I'm just saying from a personal perspective is to sit there and say, I think the council as a whole should probably be afforded the opportunity to say whether they support what administration is recommending before, I suppose, the audit committee provides comment. That's so again, I just reiterate, it's like, I think that there's probably a couple of processes before it comes back to council to be endorsed for public consultation as well. You know, from a process point of view, but if the council's happy for it to go to the audit committee before it's been I suppose endorsed, we'll do it that way.
Okay. Are people interested in having another workshop and nutting out ideas, or is that not something people want to do? Yes, Councillor Koch.
Yeah, look, I would agree with that because people need to really look at the budget and say what they think, because you get to a point where you have to make a decision.
Yeah.
There's been a number of times when the budget almost did not get adopted by the council, and everything would have stopped completely. There was one vote that only got up by one vote, which I think is odd. You know, after everyone's had a chance to go through everything. So I think people need to be really conscious of what's going on, look at it, listen, talk about it, work it through, because you could get to a point where the budget isn't adopted and you have to shut the shop, basically, if you've got no budget.
Look, there's always going to be disagreements and different views, and I think we should welcome that. However, is there a desire to have another workshop? Yeah. And Councillor Hennessy.
Yeah, I'd support it. Just as an outsider, it concerned me that in past budgets, we've had a few of the former elected members standing away and saying they disagreed with the budget point. I'd rather have an workshop, nut it out, because again, this is an item that once decided is we all need to own. It's a collective decision and we all need to, so presenting a divided, I didn't agree with the budget is not a good look.
Okay, so we can look at a date for another workshop and perhaps look at what's going in, what's going out, etc. Discuss, how we get our elected member bids over the line or not. That process, we can explain that. That can happen at that workshop. What do you think, Mick? Sorry, I'll just ask Mick to.
Yeah, no, I agree with it being new to how you guys work your budget and that sort of thing. I really need to know the process and how I can work and actually contribute to it more. And as I said, instead of getting a shock of heap of documentation and going, what am I doing with this in 3 days time, 4 days time sort of thing. I really need to understand it and know what I'm doing.
Well, that's why I've suggested, and I know that's more work. I appreciate that. And I highly value your contributions, Sharon, and all of your team and all the leadership team. I think it's really, really important that we work collaboratively together. But how we go about that, I think we can do that in a workshop. And then when we get our papers, we've had that discussion, we've had that sort of preliminary look at it, and we're not getting so many surprises, and we're sort of understanding it a little bit more. It takes a little while, I think. Anyway, we'll look for a date that is reasonable. Yes. CEO, do you want to have any closing comments?
Yeah, just further to the discussion had, I think given where we're at, firstly, new council, there is a lot of information to soak in. There will be some material changes to the bids that we will present, and we'll present that leading up to the next conversation. I think that will be a workshop, and such that we're all as comfortable as we can be, and so that when we do present it for formal deliberation by council, that there is consensus, and that when we do present it to the council, to the community, that it's based on hopefully a clear majority vote. So
So, all right, well, we'll look for a workshop date. If that's what people, I haven't heard everybody, but nobody's yelling at me saying no. So, oh, sorry, Sharon. Sorry.
I just from a timing perspective as well, I think we just need to be cognizant that effectively to ensure that we can actually adopt the budget at the June meeting, which is where we're currently scheduled for. We have planned to go out for community consultation at the start of May. So obviously that's the time frame. So with regard to it, if we're putting a just the budget and the workshop and a special council meeting will have to actually be in quick succession. And while I've got everyone in the room as well, so obviously we are still going forward, you know, as part of the participatory budgeting
Yeah.
component. Obviously, we haven't had, you know, at the moment, the draft budget has a budget for a total budget for $40,000
Mhm.
for projects
Yeah.
and potentially projects up to $20,000. So what we'll actually do is that communications will start going out from next week
Okay.
with regard calling for nominations.
I mean,
for-
and that there's a motion on notice, as we know, and that will run its course.
Yep.
And, yeah.
So the documentation will just be basically talking about eligible projects up to the value of $20,000. So the communications won't say what the pool of funds that are actually available. It will just say that projects up to $20,000 are eligible, so they can, you know, someone can put in a $5,000 project or a $10,000 project, and obviously once we get the nominations and then we'll do the assessment. One of the reports that will probably come back to the March meeting will probably be obviously to appoint the working group to do those evaluations.
Yeah.
And then we will go through doing the voting on those projects concurrently with the community consultation process as well. So doing those together. So I just thought I'd let you know that now, while you were all in the room,
Thank you.
and
Sharon.
save me an email on Thursday.
Thank you.
So yeah,
That's
so
Thank you very much. Okay, I think we'll call this to a close. Thank you everyone for coming along, and we'll look for another date, and see you, Jim. So, yeah, thanks everyone.